In today's episode of the Daily Brief, I'll talk about two important stories. First, I'll break down Reliance's latest quarterly results, where digital services and retail are emerging as the real growth drivers, while their traditional oil business stays steady. Then I'll explain what the World Bank's latest economic forecast tells us about how emerging economies like India are changing the global economy. Welcome to the Daily Brief Show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. This is Tarun again, your backup host. Anurag and Kashish are still on leave, and since we couldn't find anyone else, you'll have to make do with me today as well. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcasts. If you prefer video, you can listen along with interesting charts on YouTube. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the comments. Let's start with the first story. India's largest company just announced its results, and everyone's talking about how they've exceeded expectations. Reliance Industries saw their revenue grow by 8%, EBITDA jump by 8%, and profits surge by 12%. The stock markets loved it, pushing the share price up by 2.65% in a single day. But let's look beyond the headlines. When you're dealing with India's biggest company, by any metric, the story is always more interesting than just the numbers. Reliance operates like a mini economy with 4 key business segments. Today, we'll break down each one, starting with the business that will drive future profits. The stars of the show: digital services and retail. Just look at this. Of the extra 3,500 crores in operating profit they made this quarter compared to last year, digital services brought in a massive 68%, while retail added another 17%. And this isn't just about today. According to Motilal Oswal's report, these two segments will drive all the incremental operating profits over the next 4 years, that is FY24 to FY27. Meanwhile, their traditional oil businesses are like reliable old engines, not growing dramatically but consistently delivering cash flows. Let's start with digital services. Jio has become the world's leading standalone 5G operator outside of China with 17 crore subscribers. Here's something impressive. 5G now handles about 40% of all their wireless traffic during the quarter, and Jio's network attracts about 70% of all new 5G devices sold in India. The big news: their price increase strategy is finally paying off. Remember when Jio raised prices in July 2024? Well, they're seeing the results now. Their average revenue per user, or ARPU, has been climbing for 2 straight years after staying flat for a while. Sure, they lost over a crore subscribers last quarter. Many switched to competitors like BSNL, but things are stabilizing. They've already added back 33 lakh subscribers in Q3 FY25. There's still one challenge though. Capital expenditure remains high, and their free cash flow isn't that great. But there's good news. Their heavy spending seems to be slowing down. Looking at the first half of FY25, spending has decreased compared to FY24's levels. Analysts at Motilal Oswal are even calling this the peak of Jio's Capex cycle, expecting spending to decrease as their major 5G and fiber optic rollout completes. Any savings from Jio's reduced spending will likely be offset by Reliance's investment in new energy. Think solar, hydrogen, and battery projects. But the key takeaway: the heaviest spending for Jio might be behind them, giving room for better cash flows. Now, let's move on to retail. After a rough patch with slowing growth and even degrowth last quarter, Reliance Retail is back to growing. Revenue jumped 8.8% year-on-year in Q3 FY25, reaching 90,333 crores. How did they do it? Through productivity improvements and store rationalization. Let's break that down. Productivity improvement means doing more with less, streamlining operations, optimizing store layouts, and improving customer engagement. Store rationalization involves closing underperforming stores while focusing on profitable locations. While this might seem strange for a growth-focused retail chain, it's smart for long-term efficiency. They've added 779 new stores, reaching 19,102 total stores, while actually reducing their retail area since the start of the financial year. Reliance Retail covers everything from electronics to apparel to grocery. While it doesn't represent the entire Indian consumption market, its performance gives us valuable hints about broader consumption trends. If they're bouncing back, it might signal improving consumer sentiment and spending, especially in groceries and apparel. And here's a fascinating success story. Campa which Reliance acquired in 2022 for just 22 crores, has captured over 10% market share in the sparkling beverage category in select states and is on track to cross 1,000 crore revenue in FY25. In their oil exploration business, production from KG D6 basin has remained steady at 28 million standard cubic meters per day. Gas prices are slightly better at $9.74, up from $9.66 last year. While this isn't their biggest revenue generator, it's crucial for their downstream operations, providing essential raw materials like natural gas and crude oil. Their EBITDA grew 5% quarter on quarter to 5,570 crores, though it's down 4% year on year. They're keeping investments moderate here, focusing on maintaining production rather than aggressive expansion, and may reduce E&P investments further as they shift towards new energy ventures. Finally, let's talk about their traditional oil to chemicals or O2C business. This division, still their biggest revenue generator, showed resilience with 2.4% year on year and 16% quarter on quarter growth. They processed a record 17.9 million metric tons of crude, up from 9.1% last year, thanks to strong domestic demand. Transportation fuel demand jumped 17%, suggesting increased economic activity. But margins tell a mixed story. EBITDA per ton fell 7.5% year on year to $95 due to weaker petrochemical and polyester segment margins. However, compared to last quarter, margins improved by 14%, helped by better refining cracks in products like gas oil and jet fuel. They're investing heavily in modernizing O2C operations, focusing on efficiency and sustainability. While spending remains high, it's starting to moderate, with some investment now going towards green initiatives like carbon capture and hydrogen production. The big picture? Reliance's results confirm what we've been seeing. Digital services and retail are driving growth, while their oil businesses remain stable. They're also betting big on the future, with $10 billion committed to new energy ventures. But that's a long-term play. For now, digital and retail are leading the charge. Now let's move on to the next story and discuss what World Bank's latest economic forecasts tell us about emerging economies like India. I have analyzed the World Bank's massive 250-page Global Economic Prospects report to bring you the most important insights about where our world economy is heading, with a special focus on South Asia. Let's start with the big picture. The global economy has reached a turning point, and honestly, it's not the most optimistic story. Global growth is settling at 2.7% for 2025 and 2026. Now, this might not seem bad until you compare it with pre-pandemic average of 3.1%. What's concerning is that this isn't just a temporary slowdown. We are seeing fundamental changes that suggest this could be our new reality. Here's what's happening on the ground. Global trade, which used to power economic growth, is struggling. Think about this. From 2000 to 2019, global trade grew by about 5% each year. But from 2020 to 2024, that growth has dropped to just 2.5%. This isn't just about numbers. It affects jobs, businesses, and real people's lives. What's making things worse is something economists call trade fragmentation. In 2023, we saw the highest number of trade restrictions since we started keeping records in 2009. And it's gotten more complicated than just tariffs. We're talking about export controls, investment restrictions, and complex regulatory barriers. Look at the semiconductor industry, for example. Companies are completely reshaping their production and investment decisions based on geopolitics rather than pure economics. This is changing how global supply chains work. Here's something concrete. If the US raises tariffs by 10%, it would cut global growth by 0.2%. If other countries fight back, which they probably would, that impact grows to 0.3%. To put that into perspective, that's like erasing New Zealand's entire yearly economic output. And here's something interesting about services trade. It's actually been growing faster than goods trade since the early 2010s. Services now make up 24% of global trade, changing how economies develop and handle global challenges. Here's something critical in EMDEs. Almost 70% of countries will see lower growth between 2025 and 2026 compared to the averages between 2010 and 2019. This combination of higher interest rates and slower growth is particularly challenging for developing economies. Speaking of challenges, let's talk about inflation and interest rates. By late 2024, inflation was at or below target in over 60% of economies. While interest rates in advanced economies are expected to fall in 2025, they'll stay much higher than the unusually low levels we saw in 2010s. Although inflation has been falling in most advanced economies and EMDs, resilient economic growth and robust wage growth could result in more persistent global inflation than projected, potentially forcing central banks to maintain higher rates. While developed economies have been struggling, emerging markets and developing economies, that is EMDs, have been rewriting the economic rulebook. The numbers are incredible. EMDs now represent 45% of global GDP, up from 25% in 2000. They drive 60% of annual global growth, double what they contributed in the 1990s. They're home to 85% of the world's population. And here's a striking change. These economies received 21% of global capital inflows between 2019 and 2023, compared to just 6% between 2000 and 2004. Three countries stand out: China, India, and Brazil, the EM3. Together, they produce about 25% of global GDP, up from 10% in 2000. That's more than doubling their share of the global economy in just over 2 decades. These emerging economies are also reshaping commodity markets. They've been using more primary energy than advanced economies since 2004 and more metals since 2007. China alone now uses 60% of global metals, up from just 13% in 2000. But these economies face serious challenges. Their growth has dropped from 5.9% in the 2000s to 3.5% between 2020 and 2024. By 2025, they're looking at their lowest 5-year growth potential since 2000. They're also dealing with massive debt. Government debt reached 70% of GDP in 2024, the highest since records began in 1970, largely due to COVID-related spending. The creditor landscape has become incredibly complex, with China emerging as the largest single bilateral creditor to other EMDs. Adding to this, climate change poses a huge threat. Climate disasters are becoming more frequent and expensive and could push over 130 million people into extreme poverty by 2030. These countries are increasingly interconnected. Almost half of their exports now go to other EMDs compared to just one quarter in 2000. Let's focus now on China and India, two giants reshaping the global economy. China is going through what experts call a managed slowdown. Growth is expected to drop to 4.5% in 2025 and 4% in 2026. They're dealing with major challenges: a property crisis, an aging population, and the need to shift from investment driven to consumption driven growth. Here's an interesting comparison. When China's growth increases by 1%, other emerging markets grow by over 1.8% over 3 years. But when the US grows by 1%, emerging markets grow by 2.9%. This shows that while China's influence has grown enormously, the US still leads global economic trends. But on the other hand, if growth slows down either in China or US, the entire global economy will suffer. India, meanwhile, is emerging as the new growth star. With expected growth of 6.7% in both 2025 and 2026, it's set to remain the world's fastest growing major economy. This growth comes from a booming services sector, improving manufacturing, and strong consumer spending backed by a better job market. But India faces its own challenges. Higher inflation and slower credit growth have hurt urban consumption. Investment and manufacturing growth remain weak, and government spending stays low, both at national and state levels. The bright spot: rural areas are showing signs of recovery thanks to good monsoons. India has another advantage: its growing working age population. While China's workforce is shrinking, India's is expanding. By 2050, this demographic difference could dramatically change global economic dynamics. Now, what does all of this mean? We're not just seeing economic changes, we're watching the global order being reshaped. Yes, there are serious challenges from debt to climate to geopolitical tensions, but there's also unprecedented opportunity. The rise of emerging economies isn't just about shifting economic power, it's about new markets, new innovations, and new ways of doing business. And before we wrap up, let's move on to the final section and look at 3 tidbits. First, Torrent Power has announced a substantial 18,000 crore investment in a modern thermal power plant in Madhya Pradesh. The project, expected to generate over 7,000 jobs, is a part of a larger 32,520 crore investment initiative aimed at transforming the region into an industrial hub. The development marks a significant step in strengthening the state's energy infrastructure. Second, in the edible oil sector, India's palm oil imports are set to reach a 5-year low in January 2025, with volumes expected between 340,000 and 370,000 tons. This decline is driven by negative refining margins and premium pricing compared to soy oil. Refiners are increasingly shifting to alternatives like soy and sunflower oil, indicating a notable change in India's edible oil trade patterns. And third, Suzuki has unveiled ambitious plans for India's electric vehicle market, announcing a $4 billion investment to double its production capacity to 4 million EVs annually by 2031. Starting with the e-Vitara launch, Maruti Suzuki aims to contribute significantly to India's target of 30% EV penetration while establishing export capabilities for markets in Japan and Europe. This investment underscores India's growing importance in the global EV landscape. And that's it for today. I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.